My stocks and shares ISA has just reached £75,000, which for me is a massive milestone. So today I thought I'd make a video sharing every lesson that I've learned along the way. And by the end of this video, you will have everything you need to know about the things you should be avoiding and also the things that you should be focusing on so that you can reach a goal like this as well. Starting with lesson one, which is keep it simple, stupid. I actually first heard this saying from Morgan Housel, who is the author of The Psychology of Money, when he was on the Diary of a CEO podcast. And I think it really stuck with me because when it comes to investing, I've tried almost everything. I've invested in bonds, stocks, REITs, funds, commodities, even meme stocks, you name it, I have probably invested into it. And the funny thing with all this is that despite every time I thought I was outsmarting the market, I'm now just back at square one doing what I should have done all along, and that's investing into a globally diversified index fund and just forgetting about it. Here it is right here. As you can see, all of my £75,000 is invested into Vanguard's FTSE All World ETF, and doing this has really just helped me realize that investing is actually quite boring, but that's exactly how it should be. Lesson number two is that everybody is an expert during a bull run. You see, back in late 2020, I spent a lot of time watching some of the big US YouTubers talk about the stocks that they were buying on a day-to-day basis. And at the time, it seemed like everything they said they got right. But then I actually realized something. Pretty much every single stock in the stock market was going up at this time as well. It didn't really matter what you picked during the bull run, you'd probably find yourself in the green making money. The thing that I quickly forgot was that whilst all of this was happening, instead of buying the stocks that fit well within my own risk tolerance, I was getting suckered into stocks that had no backbone for when things actually did take a turn for the worse. Of course, you know what happens next. 2022 came, and then things did actually end up taking that turn. Most of the stocks that I was investing into had crashed, and some of the investments that I basically copied from others even went bankrupt. And all of this just left me having sleepless nights during this period. I was anxious about how much I was losing at the time, worried about what the market would do the next day, and all of this could have just been avoided. So the lesson from this is that absolutely nobody knows what the hell is coming next, and you should never be investing based on what somebody else is telling you online. Lesson number three is choosing the wrong platform and account can cost you thousands in the long run. Okay, let's start off with the platform first. When I first started out, I thought the best option to go for was to go for just the most well-known. I thought surely the most well-known would also be the most trusted as well. So with that, I just went with my bank. Now it turns out that most banks' investing sections of their apps are absolutely terrible, and they also charge you ridiculous management fees as well. So this is what you need to look out for when it comes to choosing a platform. Number one, it needs to have little to no platform fees. Number two, it needs to be easy to use. Remember, investing has to be simple, not complicated. Number three, it needs to offer lots of different stocks and fund options. And number four, most importantly, if you're in the UK, it absolutely has to offer a stocks and shares ISA. Which brings me nicely about talking about the right account now. So when you sign up to start investing with a provider, they're usually going to be presenting you with two investing options if you're in the UK. You'll have a general investing account and you'll also see a stocks and shares ISA. Now, one of these accounts can wipe out half of your gains in tax when you decide to sell your stocks, whereas the other, you won't pay a single penny. Now, I know which one I would go for, and that's going to be the stocks and shares ISA. I'll keep it short, but with this account, you can essentially add up to £20,000 a year, and any gains that you make from your investments inside it will be completely free of any capital gains or dividend tax. It doesn't matter what your account grows to, as long as it's in an ISA, you're going to be absolutely fine, which is why it's so important that your investing platform offers one. Now, I've actually partnered with XTB on this video, and their investing platform meets all of this criteria. They offer 0% commission on investments in stocks and ETFs. Their app is easy to use with over 8,400 assets to choose from, and most importantly, they offer that flexible stocks and shares ISA. I personally think that XTB is one of the best platforms on the market right now, so if you did want some more information about XTB, you can find a link to their platform in the description of this video. Lesson number four is the best investment is always the one you're most comfortable with. So right now in investing, there actually seems to be a bit of an ongoing debate. Should you pick individual stocks or should you just buy a global ETF and leave it? Now you already know which one that I do. I just pick a global fund and completely forget about it, but that doesn't mean that that would be the best option for everybody. I know with my investing, I'm taking very much an average approach here, and with that, I expect that I won't get the best returns. but that's something I'm absolutely okay with. The only real data I can give you on this is that there was a report that came out in 2022 that did find out that almost 80% of active fund managers are falling behind the major indexes. These are people that are trading investments, individual stocks daily in a bid to outperform something like the S&P 500, and so far 80% of them have failed to do so. So with that said, maybe you could look at it that way and think that if you could be in that top 20%, then the answer may be easier. But remember, there is actually never a right or wrong answer. Of course, one thing I haven't mentioned is that there's no rule about having a mix of the two either. In fact, that's probably the best option for most. Lesson number 5 is don't worry about returns at the start. Instead, focus on your contributions because they matter so much more. For this, I want to use an example, and let's say we're investing £1,000 and let's say that investment went up 10% in the first year. This is obviously great. It's pretty much in line what the S&P 500 is averaged over the last 30 years. And after 1 year, you're going to have £1,100 invested in the market, which obviously, like I said, is fine. But let's say you just kept it like that and never agreed to add any money again. Now, this is going to take you a very long time for your money to compound and grow like maybe you would expect it to. However, if we use the same example of 10% growth once again, but this time let's say we invested £100,000, that's going to be £110,000 that you're going to have after a year. This time you've got the same investment performance, but a much bigger difference because you've built a bigger portfolio. Now, one thing that I do want to make clear is that you don't have to be going and finding £100,000 straight away. I mean, I'm not even there myself yet, but what I am starting to realize, and a big lesson here, is that when the markets start to move, my investments are seeing much bigger gains every single time. And that's because I focused on adding more, not the performance of what I already have inside. Lesson number 6 is you make your money during the crashes. Now, this is a really hard one to learn because investing is pretty much like nothing else. But one thing I've been really leaning on lately, which has really helped me, is that based on historical data, the stock market has always recovered no matter what we've gone through. It could be wars, it could be pandemics, it could be a financial crisis. Every time the global market has always recovered, and from there it's actually gone on to reach new all-time highs. Lesson number 7 is that consistency always beats timing. Now, I'm sure you heard of that famous saying, timing the market beats timing the market, and there's also a stat to back this one up as well. On screen, what you can see is a study done on investing in the S&P 500 index, and on the chart on the left it shows that 50% of the stock market's best trading days have come during a bear market, and the chart on the right shows your investment amount depending on how many of the best days you missed. Now, looking at this, I think it's absolutely wild that if you missed just 10 of the best days over that entire 30-year period, your investment value would be over half of what it would be if you just stayed invested throughout the whole time. That is literally half your gains gone because you tried to time the market and got it wrong only a handful of times. So what does this tell us? Well, it's pretty obvious. Stay invested, keep showing up. Don't try to be clever because the market rewards patience, not predictions. Look, I'm not going to sit here and say that investing is easy. It's definitely not. There will be moments of doubt, moments where you question everything that you're doing like I have done in the past. But if you can keep it simple, stay consistent and focus on what you can control, not nobody else, you will get there, and I hope that I'm proof of that. Now, if you've watched this and you want to get started with investing, I do have some free investing guides that I've linked below. But other than that, I hope you liked this video. Drop it a like if you found some value from it, and I'll see you in the next one.